Hey, so quick heads up. This episode is audio only. We had a Riverside video glitch, but the insights and conversations in this episode was pretty important. So I just wanted to give you that overview here before you dive in. So here's the thing. If you're a high earning tech professional, taxes are probably one of your biggest expense. I definitely know that, this is true for many other tech professionals I've talked to, and I have some personal experience with this part too. So it's just what it is. So the question is, what if you could legally keep far more of what you earn and even use the tax code to accelerate your wealth, right? Makes sense. You've probably heard about this in many different strategies, but today, this conversation, we actually get to talk about how to create passive activity losses that shelter your income from your investments, and in some situations, even reduce your W-2 income when structured correctly as well. I think that's an important thing to talk about because oftentimes you'll hear about these passive activity losses as it's concerned to, well, your passive income. But what we do is we talk about things like, 1031 exchanges, understand opportunity zones, and when they could help you to, grow future growth at completely tax free. And especially, it's useful if you've cashed out some of the tech stocks. And so today's guest is Jason Melillo, the CEO at KBKG. He's an entrepreneur, he's a CPA, he's a real estate investor, of course. And him and his team have helped clients to save billions in tax savings. And here's what we're going to really be talking about: cost segregation, right? We're going to talk about, of course, set that baseline in any good tax conversation, where we're accelerating depreciation that lets you shelter more of your early cash flow from these taxes. We're going to talk about bonus depreciation a bit. You might have heard about this one, and how it helps you to front load some of your deductions and dramatically improve your year one cash flow. Of course, you want to make sure that you actually have conversations with your CPA, a CPA, to make sure it applies to you as well, and if it's a good strategy for you. But it's important to learn about, right? We're also going to talk a little bit about, his take on limited partnerships and questions that you should be asking your syndicator, asking your whoever is providing the investment that you're looking at, right? Will you be running a cost segregation? How are the deductions allocated? What's the after-tax yield, from the 5 to 7 year shelter window? Whatever it is, those types of things we talk about, and when not to accelerate. Like I was talking about, it's good to understand bonus depreciation, but it's also good to know when it's not a good strategy for you. So that's really important. One of the things we spend a good amount of time on, and because I've never had anyone on the show yet talk about this, is reps. What is reps? Reps is the real estate professional status. And so here we're going to talk about what qualifies, what counts toward this, and how high earning couples can use this where one spouse's real estate activity can offset the other's income as well. W-2 income. That is a big one because, like I said, with the PALs, the passive activity losses, sometimes your investments can only offset that. But with reps, it can actually offset the W-2 income as well. So that's actually super cool. So I really enjoyed this conversation with Jason. Definitely check it out. And as usual, if this is useful, go check out Jason's stuff. Give that, the resources, check into it. Links to Jason's work, KBKG, and the residential cost segregator is in the show notes. And also use the promo code PATHCODE2025 for eligible properties, also in the show notes. Again, if this is useful to you, please, I would super appreciate you subscribe to the channel, especially the YouTube there, and any quick review from wherever you're listening to, Apple Podcasts, Spotify, I would absolutely appreciate. Thanks so much, and enjoy and dive in. Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Jason Melillo is a recognized leader in real estate tax strategies, particularly in cost segregation. With over 25 years of experience, Jason was instrumental in building KBKG, a national leader in cost segregation studies. It has helped real estate owners, companies, and CPAs save over $10 billion in taxes. Through his leadership, KBKG revolutionized tax planning for real estate investors and continues to provide innovative strategies to unlock tax incentives created by Congress. Jason, super stoked to have you here. We're going to dive into some really useful topics, I think, for our listeners, some of which we already talked about to make sure we provide maximum value. For those that don't know you already, can you please introduce yourself in your words and talk about who you are and your background? Then we'll get into it.
Sure. I like to tell people I'm an entrepreneur that happens to be a CPA. So I, certainly understand the tax world, but also like building out an enterprise and helping people to do the same. So that's really what we do here. I'm also a real estate investor, so I like to mix business with pleasure, so to speak. But really happy to be here and happy to share my knowledge to help other investors optimize their opportunity for minimizing tax and maximizing cash flow.
Yeah, I mean, it's the things we'll always want to do: increase the top line and lower all of our expenses, right?
Well, yeah, it's being good at offense and defense.
Mm-hmm.
Offense is generating income. A lot of people are really good at generating income, but they don't have time or the ability to pay attention to how to reduce the outflow of cash, and taxes. One of your biggest, if not your biggest expense. So this is why we exist.
Perfect. So, talk to me about how you do that, right? I mentioned cost segregation. There's many other things you cover. You've mentioned 1031s for those who have heard that before, Delaware statutory trust as well. We're going to dive into opportunity zones. You have a lot of information, but how do we actually go about achieving that mission you were talking about?
Well, I think real estate as an investment itself is probably the best way to invest tax efficiently. When you invest in stocks and bonds and things like that, sure, those can grow tax free until you have to sell them and recognize a gain and pay tax. And if you're balancing your portfolio periodically, you're always buying and selling stocks. And so that's creating a tax impact. When you invest in real estate, particularly investment income producing real estate, there's some significant tax benefits in the form of depreciation. And just to back up for a second, all depreciation is an expense of your capital investment over a statutory period of time. So for residential rental property, that happens to be 27 and a half years. So if you buy a rental property for $270,000, you're getting a deduction of about $10,000 a year against the income that's produced from that residential rental property. So if it's generating $20,000 a year of income and you get a $10,000 deduction from the depreciation, you have taxable income of $10,000. What cost segregation does is it allows us to accelerate or front load that depreciation deduction. Instead of taking $10,000 a year, it might allow us to take 25 or 30 or 40 or $50,000 in the first year or over the first 5 years, depending on how much property gets qualified. And we can kind of talk about how that works. And then we can talk about supercharging that with bonus depreciation. And we can talk about how that works.
Super cool. So, I like that you give that number 270, right? That makes it easy, especially with those years of the 27 years and that 10%. Is it end up being 10%? So I like how you gave that $270,000 number because it is depreciated over 27 years for a residential property. So it makes some of that math a bit easier. And so where it would be an even depreciation every year, you were saying bonus depreciation allows you to capture some of that depreciation much earlier, right?
Right, right. So what the cost segregation study does is it allocates a portion of the property into shorter life asset classes. And shorter life asset classes qualify for bonus depreciation. So, uh, for example, if we're talking about a apartment, um, the products of certain elements of the kitchen in an apartment, for example, cabinetry, countertops, those types of things qualify for a 5 year life instead of a 27 and a half year life. So, again, just keeping the math simple, if 10% of our $270,000 property fell into that 5 year bucket, that's $27,000. That 27,000 would normally be depreciated over 5 years instead of 27 years.
Mm.
What bonuses allows us to do is if we're placing it in service for the first time, now we get 100% of that deduction in year one. So we get a $27,000 deduction in my example. Instead of spreading that 27 over 5 years, we're taking it all at once.
And so, what does that ultimately allow? Then you're talking about saving that cost. What does that ultimately allow for that investor?
So, what it allows the investor to do is it allows the investor to have more passive income without creating taxable events. And I want to reiterate passive income because we're assuming right now we're just talking about somebody who's made an investment in a real estate property. They're not a real estate professional, they don't do this for their living. And so they can only offset that against passive income. So if I had $20,000 of passive income, I'm able to wipe out that $20,000 of passive income this year. And anything that I have as a deduction in excess of that 20, I carry forward to the next year. So if next year I've got another 20, or maybe it's gone up now, it's 25, well, I'm sheltering that 25 because I carried forward, let's say, 20,000 from the prior year, plus I'm getting, another 10 or 15,000 in the second year. So I'm able to take cash flow that I would otherwise be paying in taxes and do something else with it. And that something else might be investing in another real estate property. It
Mm-hmm.
might be investing in stocks and bonds, whatever. It might be, buying a second home for myself that maybe I'll then use to visit part of the time and rent out part of the time.
I wanted to ask though, because this is a question that I've heard of a bit, but I don't have all the details on. So I'm hoping you can shed some more light on this too. Is that this sounds great, right? The passive income, the income that we get from a property that we receive, will be offset by this depreciation, right? This
Yep.
that's what you're talking about, wiping it out. But is that always the um, is there ever a time when this has to be paid back at all? Because, right, usually if there's a sale or some kind of capital event, it has to be recaptured some way, right? Is this always a good strategy, or are there
Yeah.
cases that there should be or shouldn't do it as well?
I would say it's most of the time a good strategy. The only time that it wouldn't be a good strategy is if your intent was to sell your property within a short period of time. Maybe, 1 to 3 years you would look at that and say, well, I plan on selling this particular property next year. If that's the case, then you're not going to want to go through this strategy because you'll have one of two things happen. One, you'll either have to recapture the deductions that you took at ordinary income tax rates. So it provided no benefit. You got a deduction at ordinary rates, and then you picked it back up at ordinary rates. You were trading dollars for a period of time. The longer that period is, this is a time value of money benefit to a taxpayer. So the longer you have that money that you get to choose what you do with it is the greater the benefit for you. So if you were going to exchange that property into another real estate investment, that's
Mm-hmm.
the 1031 exchange you referenced, that's fine. You can do that. And I would say, if you were dead set on selling your existing property and exchanging into a new property in 6 months, that, well, maybe there's no need to do the cost seg on the initial property. We just wait until the exchange is completed and then do it on the exchange property. But if your plan is, hey, I'm going to hold this property, for at least 5 years, and I expect that I'm going to continue to stay invested in real estate because that is something that I want as part of my investment strategy to be invested in real estate, then yeah, if you're generating taxable income from your passive activities, you definitely will benefit from the cost seg study. And then as you get to the place where maybe you want to further diversify geographically, your investment is not just going to be in the one location, but you want to spread it to, two different states for some reason because you want to just have better diversification. You split that property, you change the one into two, maybe add some debt onto it, and now you've got some additional property that you can depreciate. You're more diversified, and you have more potential income.
Awesome. Um, I think it's important to call out that there's, we talk about real estate investors, right? We talked about people that are, buying to, their secondary home or maybe another rental home as an example for investment purposes. But what about for passive investors as well? What do they need to know about this? Can they, and when they're thinking about, this strategy as well, is it something that they should only look out for their operators? What guidance can you give both the people acquiring properties as well as passive investors?
Yeah, so if you're talking about more like the institutional folks, um, they would want to make sure that they're educating their investors. That if you're part of you're a limited partner in a partnership, the general partner should be providing information to you as a limited partner as to here's some additional tax benefits that we can pass through. Sometimes those tax benefits don't benefit everybody. So the general partners may opt not to do a cost seg study, for example, and let the individuals do the cost seg study on just their interest. And that's only because there's a decision about, do I spend the money where some maybe half the people don't have passive income, so they wouldn't benefit from spending the money on the cost seg study, versus the other half that do, so they might leave it to the individuals to make their own decision. But most of the time, it makes more sense for the GC, for the general partner, to do it at that level, because then they can just provide the details to everybody.
So my question was, it sounds like that it definitely depends on if it's something that the team putting together a deal, the general partnership team or the team just putting together that deal, if it's something they're deciding they do. So it sounds like the guidance should be that for the passive investors that are looking to invest in deal, that they always ask those questions to the partnership team. Would you agree with that?
Yeah, 100%. Yeah, 100%. As a matter of fact, a lot of times when a syndicator is going out to raise funds, they'll come to us, ask us to give a preliminary benefit estimate for the project so that they can wrap that into the subscription agreement, as this is part of the ROI that you're going to be getting. We're going to be providing these tax benefits that are going to accrue over time so that you can really see what your cash on cash return is going to be as an investor. So that ultimately, if they know that there's going to be, maybe a 9% return each year, that is the after tax. Where if it was with a tax impact, maybe that return would only be 7% instead of 9. So that helps them to provide a more realistic picture of what the benefit is going to be.
So this is actually really cool, right? You're talking about this story, right? This really the exchange that you have with your clients who are syndicators, who will come and say, Jason, help us evaluate this property, help us understand if this is, what our return on the segregation study or any additional tax benefits we can get here so that we can offer it to our investors, right? And so you're giving us, the
Exactly.
listener, the kind of the behind the scoop of what the syndicator goes and talks to a team like yours about. So, you know, what can you share that the investors might want to ask, or what they should know so that they can be more intelligent investors?
Yeah, I would just say, are there certain tax benefits that you've already thought through for this particular property, so that I can understand when I get income from this project, am I going to get uh, more cash flow than the amount of income that's passed out to me? And the answer should be yes, right? If you're getting $10,000 back per year on your return, that 10,000 should be coming back in most cases 100% sheltered, so that there's no taxable income on that 10,000 that you're getting, at least in the first 5 to 7 years that you have that project.
And why would you say the first 5 to 7 years? I want to break that down a little bit for understanding why you
Yeah,
mentioned that
so
timeline.
exactly. With the benefit of cost segregation, it is pulling that building. So let's say that someone spends $10 million on a building, and the investors have invested in that $10 million. Um, Instead of depreciating that over, if it's a multifamily investment, instead of 27 and a half, or if it's a commercial, shopping center, something like that,
Mhm.
39 years, that property that we identify that qualifies for shorter life. And I won't bore you with what how we get there, but a lot of that property is going to end up in a 5 year or a 7 year bucket that gets
Mm.
depreciated over 5 or 7 years. So that creates this front loading effect that I talked about earlier, where we're getting those deductions in the first 5 to 7 years. So that cash flow coming back to us really should be sheltered by the depreciation that we're getting, because the syndicator did a cost seg study on that project, and then it allows you to kick the can down the road as far as when you pay taxes. And in a lot of cases, because the way that those returns come back to investors, it's not going to be taxable to them for many, many years, because it's a return of capital,
Hmm.
as well as the fact that they've got sheltered income coming in. So,
Right.
you should be in a position where, um, the way that a lot of these deals are structured, someone's getting all of their capital back before they're having to pay any tax.
Right. Right. Good call out. So, given that, there's a lot of moving parts, there's obviously technical things to know, right? The investor invests in a project, say they do, right? And they're getting some form back, 10K, right? Um, and they're like, if this is the first time they've invested, they're thinking, what do I do with this? Right? Hopefully, they've gotten some direction from their syndication team of, well, go do this and this, but it's possible that they don't, because there's a blanket statement of, you'll want to talk to your CPA, right? And so,
Yeah, and
um,
and I know that is a blanket statement, but that is true, right? We want to make
yes,
sure that the CPA is involved in that discussion, because they're ultimately providing guidance about what the tax impact is. And the one thing I will tell people is, make sure, and there's a lot of really good CPAs that specialize in real estate type investments. Um, and so make sure that if real estate is a place that you're going to be investing, talk to a CPA that specializes. So ask your CPA, is this something that you do all the time? And if not, maybe there's other reasons why that CPA is beneficial. That's fine. If this real estate investment is a significant investment for the investor, then maybe go talk to a second CPA just about that real estate piece to get some feedback on that. If the CPA that you're working with knows a different area of the law, or specialize in something different, and you're using them for that purpose, no problem. Just make sure that if they don't know real estate, talk to somebody who does.
yeah, it's part of making that great team, right?
Right.
So you mentioned this other term, real estate professional. Break that down for me. This is one that gets thrown around, here and there. I want to make sure we have a good understanding what that is.
Yeah. So real estate professional is obviously somebody who is in the trade or business of selling, renting, leasing real estate. That's easy, right? That comes to mind. If they're a real estate broker, but what if they're an investor? How do we become a real estate professional and as an investor? And I like to use the example, because if we're talking to professionals, or people in tech, investors, they may not have the time or qualify to be a real estate professional, but maybe they have a spouse that does. So if you invest in enough real estate, and you spend enough hours of your time managing that real estate. And the rules are pretty clear: 750 hours per year, um, and greater than 50% of your time. So it doesn't work if you're in tech and you say, okay, I spent more than 750 hours, but I spent 2,000 hours on my tech job. That doesn't meet the criteria for real estate professional. But if you are somebody, maybe you're part time in your tech responsibility, you're able to do in 1,000 hours a year your role as an advisor or program, whatever you do in
Hmm.
tech, and you spend 1,100 hours on real estate investing. Well, that meets the criteria for real estate professional. Now, what that does is it allows us to offset any losses we generate from real estate. And one of the things about real estate with the depreciation, we can definitely generate losses in real estate through depreciation. Um, it allows you to offset those losses for tax purposes against your other income from other sources. So
Mm.
if you've got W 2 income, or you've got income coming in from stock options,
Hmm.
or however you're generating income other than through real estate, you could take those real estate losses and apply them against that other type of income. So a lot of times for people who are married, that husband and wife uh, uh, combination of one being in real estate and the other one being a high earner, you
Hmm.
can really use that effectively, where you take those earnings, invest them in real estate. The real estate creates a deduction to shelter the high earnings, and
Hmm.
allows you to uh, have the government help to pay for more purchases of real estate. So you're putting that money to work for you without giving it to the government instead.
Yeah, that's
And
really cool.
then 1031 allows you to trade tax free into future properties. And so I always like to say, people who are the way that the tax law is situated for people in real estate, it's highly favorable for them not to have to pay tax.
You know, so I want to touch on this a little more, and you bring up such a great point. I want to highlight here, but so how does someone go about that 750 hours? And thanks for making that comparison too, right? It has to be more than the other profession, other job. Um, what are some of the activities that might qualify for some of those hours, as an example?
Yeah, so anything associated with managing the real estate, maintaining it. So if someone is a weekend warrior and they're going to manage their own property, they're going to maintain it. They're going to go in and I've got a tenant moving out. I'm going to go in and I'm going to paint it. I'm going to do some maintenance work on it. That qualifies,
Hmm.
right? If I'm working with somebody to find a new tenant, that qualifies. I'm interviewing people, or I'm managing the day-to-day collections and things like that, which a lot of people with a smaller number of properties or a smaller number of doors might be doing it themselves. If you have a property manager, even, that's still okay if you're spending time managing different elements of the property that the property manager is not. You have a lot of people who maybe have a lot of income and they've bought a
Hmm.
lot of real estate with it. They're spending a lot of time, or someone is spending a lot of time
Yeah.
to manage that portfolio of real estate. That's absolutely something that would qualify.
Okay, cool. So general rule of thumb, but definitely go get the details. Is anything that helps to manage that portfolio, and manage it could mean anything with the repairs, with getting the tenants to generate the income, other income producing things on the property, as an example for improvements, working with vendors, anything like that.
Yep.
Okay, super cool. And
Advertising for new tenants. Yeah.
got it. And then final question on that is there how much I don't know if there's a percentage or something like that, or some amount. What is the amount that actually can get offset from the other income? Is there a number or percentage for that?
And no, if you're a real estate professional, it's unlimited.
Really?
Yeah.
So so someone has that high tech income, and the other person is a real estate professional, right? The amount, are you saying that then the
Yep.
amount of let's say that the high tech income, I don't know, let's just say it's 250,000, right? Um Are you saying that
Mhm.
whatever amount that gets taxed on that earned income, that 250K, could get offset by that real estate professional depreciation or the depreciation from the real estate?
Yep, yep. So, for example, if I buy a property for $1 million
Hmm.
and um, let's say 25% of it ends up being in 5 and 7 year property, or for bonus depreciation, it's 20-year life, 20-year class life or less. So if 250,000 ended up in that shorter life property, I take 100% bonus depreciation. We're talking about an asset placed in service after January 2025, because that's what the new tax bill that was signed on January 4th allows. Then I can take that $250,000 deduction in 2025 and offset it against my $250,000 of ordinary taxable income.
Super cool. Okay. Got it. I want to move us along here because you also mentioned about that tax bill, and I want to get to that. I know that's an important one here to talk about too. I just want to see if you have any thoughts on this. Like the question comes up, like why does the government allow us to do this, right? Why does it allow us real estate investors to get these tax incentives, right? There's things in the media like so and so doesn't pay taxes or these people don't pay taxes, and the thing that I thought was really cool in my understanding, and please add more onto this, is like this is the government incentive to help the government with our economy is one way to kind of say it, right?
Yeah, there's trade-offs. That there's always a benefit when there's any type of a tax incentive placed into the code, is that it's creating a stimulus of some kind for people to do something. It's trying to stimulate either investment in multifamily so that there's more housing for people, because that brings the cost of housing down for everybody if we have more supply. It's just an economics function. When we invest in new property, we're selling more dishwashers and washing machines and furniture, and all of those things stimulate the economy. So it creates jobs for construction contractors. It creates opportunities for property managers. All these things that exist. It goes full circle, which then causes more people to generate income, which creates more sales tax and property tax
Hmm.
and income tax. And so it is, and I'm sure that there are people that will take the opposite position and say, well, that's just a giveaway to the rich. Maybe so, but it is stimulating the economy in a way that does move on to other parts of the economy, and so it creates a benefit effect.
Yeah, I mean, housing credits, energy credits, other types of things help to do that stimulus.
Right.
Cool. So you also mentioned the tax bill that was just passed. So talk to me a little bit about that. A lot of us listeners, we may not be aware of these things. So this is great to have you here to, to educate about this. What actually ended up getting passed? Why is this different than before? What does this mean?
Yeah, I mean, a lot of what was passed was an extension of the original Tax Cuts and Jobs Act, which was passed in 2017 and went into effect January 2018. And some of the things that were extended were either enhanced slightly or corrected things that they wanted to correct. Um, there's been lots and lots of discussion over the last several years about the SALT deduction, the state and local tax deduction, where it was limited to $10,000 in the past, and uh, when I say the past, under the original Tax Cuts and Jobs Act, that has now been expanded to $40,000, which, for a lot of high income earners, that was a pretty big hit to take, because when, before the Tax Cuts and Jobs Act passed, 100% of it was deductible against taxable income for federal purposes. And so if somebody made $1 million and paid $100,000 in tax, they were able to deduct $100,000 of state tax against their $1 million income. There were some limits that were factored in there. But for the majority, it was basically that $100,000 deduction. Tax Cuts and Jobs Act back in 2018, 2017 cut that to $10,000. So the person making $1 million paying $100,000 tax was now only getting a $10,000 deduction. Under the new Big Beautiful Bill, that is a $40,000 deduction. So it's not the 100,000 that they're paying, but for most people, if they're making 200,000, 300,000, 400,000, whatever in that range, they're getting a full deduction for their state taxes that they're paying, as opposed to being limited at 10. So that's a pretty nice change. I mentioned the bonus depreciation that had been stair stepping down. It used to be 100, then it dropped to 80, then 60, then 40%. It was 40% through January 19th, 2025. And now it goes back up to 100% again. So that also is a significant benefit. There's some other benefits for real estate investors, maybe a little esoteric, but I will say that there were some limits on more interest deductions for real estate investors that now has become more beneficial. I don't think it would apply to most of the people on this call, at least maybe at the syndication level,
Mm-hmm.
but probably not something that would have a huge impact on the majority of the real estate investors. But certainly it is a benefit that's there. The mortgage interest deduction um, is not really changed under the bill. Some of the other things that changed, where you can now deduct certain auto interest,
Mm.
it's limited by how much people make. So once you're over $100,000 a year, a lot of those things go away. They're not there for what the government deems a higher income earner.
Got it. Got it. Okay. So you're going back to what you were talking about, and forgive me for my ignorance on this, but I've got to ask. You were talking about the SALT, the state local.
Tax deduction.
Yeah. Does that mean that across the board, people can expect to get taxed less on their earned income?
Um, if they're itemizing their tax deductions, and they pay more than $10,000 in state tax, then yes, they should see a benefit for, um, if they're in the 35% tax bracket
Hmm.
and they were deducting 10,000 before, now they're deducting 40,000. It's about a $10,000 benefit.
Got you. Okay. Cool. But absolutely go check and talk to your CPA for your own
Yes,
situation. I got you,
exactly.
Jason. I got you. um, super cool. On uh, on our journey here about talking about different topics. One of the other, or that are helping to reduce this taxes, right? We also talk about opportunity zones, and this one is, at least in meetups and in conferences and here and there that I've been to. I don't hear this one talked about a bunch. So can you talk a little bit about what an opportunity zone is, and uh, where what it is, why it's a thing, and why real estate investors should be aware of it?
Yeah, so when the Tax Cuts and Jobs Act was passed, um, they wanted to create an opportunity for people who were selling and recognizing a capital gain, the ability to invest in something else, in real estate in particular, and in real estate that are in specific areas. So to again stimulate investment in maybe lower income areas, or areas where there have been less real estate investments in the past. And so the way it was originally written is you could defer a gain for several years. You would ultimately have to pay the gain. But if you invested in a qualified opportunity zone, you got to defer the gain for a number of years. And then any growth you had in your investment would be federally tax free if you held it for 10 years. So if you had $1 million gain, you invested in a qualified opportunity zone, you eventually pay the tax on that $1 million gain. But if that you reinvested that $1 million in a qualified opportunity zone, and that million grew to 3 million, that 3 million would then be tax free, assuming that you had met the criteria of the opportunity zone requirements. So you held it for 10 years, et cetera. So
Yeah.
now all of a sudden you've got a $2 million exclusion on taxable income.
Yeah.
That's a 700,000. Well, capital gains rates a $460,000 benefit. So pretty significant for that $2 million investment.
Definitely. So that would definitely increase your return on investment, obviously, because less taxes.
Exactly. So under the new bill, that opportunity zone was expanded. There's no deferral of your gain anymore where they had before, but the investment in the opportunity zone, all that growth is tax free. Um, when you recognize that gain sometime in the future. So you can accomplish the same thing without an opportunity zone by just 1031 exchanging until you die, which is what a lot of real estate owners do. So
Hmm.
it's there's two different ways to get there now, um, and it gives you a little more flexibility.
Okay, so based on what you said there, um, where it becomes advantageous, it becomes an advantage if to invest in an opportunity zone if the strategy is to not 1031 as an example.
Right, right. If in the case of somebody that is selling a non-real estate asset, then there is no 1031 option, right?
Hmm.
This is a way to create a future benefit. So you're selling, um, if you mentioned a lot of your listeners are in tech, so
Hmm.
somebody who has gotten stock options, they've held them for a number of years, they've grown substantially. Maybe they've got 3-4 million dollars of gains that they've had from these options, and they're gonna recognize that, and they're gonna have to pay tax on that. um, but they want to reinvest a chunk of that. And because they may have future options, maybe they have already uh, risk in the market. Maybe a lot of times you don't want to reinvest in tech because you've already got enough invested in your options.
Yep.
So out of that 4 million, let's say it's 3 million. Out of that 3 million, they're going to sell it, convert it to cash. They're going to have tax on that. Let's say six or $700,000. That gives them 2.3 million left to invest. That 2.3 million is invested in real estate, with the benefit of borrowing. Maybe they were leveraged at 50%, so they're able to buy a really nice property. It's going to create cash in taxable income that's cash sheltered by the tax deductions, right? So they'll get cash return on investment each year. Um, and then if it's in that opportunity zone, that growth on that investment is tax free for federal purposes, assuming they meet the criteria for the opportunity zone rules.
I mean, these are things that most definitely we can just go and Google, right? Opportunity zones, learn more about where they are. Do they keep changing? It seems like they might in where they're located, because after there's some growth, maybe
Yeah, I
that
mean, there's
they're.
there's a whole there's a whole site that the government has that, like you say, you can Google the list and just say opportunity zone locations, and you can then see where they are. But a lot of syndicators will provide investment opportunities, even through people's regular broker dealers. You can find alternative investments that are in qualified opportunity zone investments where they'll if you tell them, look, I've got 2 million or 100,000 or whatever, I'm an accredited investor, I've got this money to invest. I want to invest in opportunity zones. There's an abundance of them. It might be a hotel investment. It might be, uh, multifamily. It might be, any number of different types of investments that you can invest in that are qualified opportunity zone. Self storage is another one
Mhm.
that you see a lot of out there.
So it applies that that zone is exactly what it is. Any of those different types of assets, those classes, the opportunity zone will apply to them as well.
Yep.
Awesome. So moving along here, you've seen a lot of stuff. Obviously, you've been keeping up with things like it's part of your industry, of course, but the tax bill and just making sure that you understand these things to apply for your clients. But that understanding comes with a lot of practice and intricate knowledge, seeing things happen. If you were to look back and you know think, I wish I would have done this or that, strategy earlier along the way, or something you wish you would have known earlier in your investing career. What's something like that would have been for you that you could pass on to our listeners who might be getting started on their investment journey? I know this is, pulling out of the grab bag, right?
Yeah, I mean, I would say that um, the one thing I would educate anybody on early on in their life is to invest for your future, especially if you're generating cash flow. And real estate is a great investment, and you cannot beat the return on investment in real estate, even when you look at the the market over time and you look at real estate over time, because of the value that leverage in real estate gives you, meaning that I can make a $10,000 investment in real estate, but I can add debt to that as well, and it tax benefits to that. When you take that 10,000 or 100,000 and compare it to the same 10 or 100,000 invested in the stock market, real estate's going to win every time. Broadly diversified and all that stuff. Just
Mhm.
to to qualify that, but it's just a great long-term investment strategy. So, um, I've been a real estate investor uh, since I got out of college, but I probably would have um, maybe taken on more um, commercial investment opportunities earlier in my life than I did. Um, and but I don't really have any regrets. I just say that I think that's the one piece of advice is, the sooner you can invest in real estate, um, the better off you're going to be long term.
Yeah. I think that's a great way to close out our call today, Jason. I thank you, really. I appreciate you being here. I know we bounced around on a couple things, but I think each of those topics were really important to, get our listeners exposed to that awareness. Talk to me a little bit about where people can find you, what you would like to help people with, and how they can contact you.
Yeah, they can find me at kbkg.com. They can also find me at Jason Melillo on LinkedIn. Um, and then I'm looking for right now. I know we have a promo for your listeners. The promo code is pathcode 2025. So if somebody has an individual multifamily property, like single standalone residential rental, we have a software tool on our website that allows you to do a cost seg on that property. And so you don't have to go out and hire engineers. Although the bigger value of the property, the more likely you'll need to do that. But for under $1.2 million, you can do it on our website. And that path code 2025 gives you a 10% discount.
Super cool. What was the site again? And the code is
kbkg.com.
Mhm.
And the software tool is the residential cost segregator. So if you go to our software section on kbkg.com, you'll see where you can um, get the benefits of cost segregation on properties that used to not just, it wouldn't make sense to pay somebody to do a full study, but the software tool allows you to get that benefit even with a lower value property.
Outstanding. And we'll make sure that is in the show notes as well, along with that promo code. Jason, sir, thank you so much. Appreciate you being here.
Yeah, awesome. That was fun.
Outstanding. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.